You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Investment Miscellany, written on the 1st of November 2000. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. All right, let's dive in today. We're going deep on a memo. It's called Investment Miscellany, written by Howard Marks back in November of 2000. Now, 2000, you might be thinking, is that a little dated?
Yeah, 2000.
This memo is packed with timeless wisdom.
Absolutely.
Really relevant even today.
Oh, for sure. I mean, what's fascinating is that Marx wrote this right after the dot-com bubble burst.
Oh, wow.
So, it was a crazy time in the market. He was
Yeah.
really grappling with, all the chaos and trying to make sense of it.
And
His observations on market psychology and investor behavior. Super valuable, especially for investors today trying to navigate all this complexity.
So this isn't just a history lesson.
No,
Right.
not at all.
We're talking about enduring principles that can help us understand
Yeah.
what markets are doing.
Yeah.
And, make smarter investment decisions. What were some of the key themes that stood out to you?
Well, one thing that hit me was Marx's observation about this, disrespect for money. Oh, interesting.
That he saw during the dot-com boom.
Okay.
Investors, they were just throwing caution to the wind,
Yeah.
chasing these crazy returns
Yeah.
without much regard for traditional valuations.
Yeah, it's like they forgot that risk was even a thing.
Yeah, totally.
But is this disrespect? Is this just a dot-com era thing, or are we seeing this today?
Ooh, that's the million-dollar question, right?
Yeah.
I think, it's a good question for investors to think about. Are there signs of similar exuberance? Are we seeing, companies with shaky business models getting these astronomical valuations?
Right.
Is FOMO driving our decisions?
Okay.
Fear of missing out.
So let's say we're seeing those warning signs. What do we do? Sit on the sidelines and wait for the crash.
Not necessarily. I mean, remember, every cycle is different.
Right.
What Marx is really highlighting is being aware of these psychological forces. When sentiment is high, it's easy to get swept up in the hype
Yeah.
and make some irrational choices.
Yep.
So it's about staying grounded,
Yeah.
having a philosophy,
For sure.
and not letting our emotions drive the bus. Now, Marx also says, you can't just expect double-digit returns
Right.
from the stock market forever.
Right.
What's the logic there?
Well, he's pushing back against this blind faith in historical averages,
Okay.
right? He points out that those impressive returns often include periods of significant PE ratio expansion,
What?
meaning investors are willing to pay more for each dollar of earnings.
And when valuations are already high,
Yeah,
you can't really bank on that happening again. Right?
exactly.
So past performance
Yeah.
isn't always a reliable indicator.
Right. It's all about context. You got to understand those factors that drove those historical returns and consider if those factors are going to stick around.
That makes sense. This brings us to liquidity,
Yeah.
how it drives market swings. Marx actually uses a framework from Richard Bookstaber, who argues that traditional models often overlook this impact of liquidity.
Yeah. Bookstaber, he's all about how during a crisis, the need for immediate liquidity, like right now liquidity, it trumps everything, even price.
So it's like, if you need to sell,
You need to sell.
you'll take any price.
Right. Finding a buyer at any price
Yeah.
becomes more important than
Yeah.
getting fair value.
So people are willing to pay less if there are more sellers than buyers.
Yeah. And that's when you get those sharp drops.
Why?
Bookstaber talks about liquidity demanders,
Okay.
the ones who have to sell no matter what.
Ah,
And then there are liquidity suppliers, the ones who come in and buy at that moment.
I'm guessing this is where Oaktree Capital comes in, Mark's firm. They're the distressed debt specialists, right?
Exactly.
They're often the ones buying
Yeah.
when everyone else is running away.
Yep. They're the bargain hunters.
Uh-huh.
But
Yeah.
it's not just about buying cheap. It's about understanding why something is cheap.
Right, right.
Is it just a temporary blip? Or is there a deeper problem?
This ties into Mark's point about information versus knowledge. Just because the information's out there,
Doesn't mean everyone knows what to do with it.
right, doesn't mean everyone can interpret it correctly
Yeah.
or make good decisions based on it.
And today, we're overloaded with information.
Yeah, for
So
sure.
that distinction is more important than ever.
So how do we avoid becoming what Marx calls informed fools? We'll definitely have to unpack that in our next segment. This is already fascinating.
Yeah, there's a lot to dig into. You know, it's funny, this whole information versus knowledge thing reminds me of Sherlock Holmes.
Oh, yeah.
That line, data, data, data. I can't make bricks without clay.
I love that. We're swimming in data,
Yeah.
but without the right framework, it's just noise. So how do we turn that clay into bricks? How do we cultivate true investment knowledge?
Well, Marx argues, it's not just about access to information, it's about understanding those underlying forces that drive markets and investor behavior. It's about having a framework to filter that information, separate signal from noise, and make decisions based on a solid investment philosophy.
Okay, that makes sense. But what does that actually look like in practice?
Let's take the dot-com bubble.
Okay.
There was plenty of information about the companies going public, but investors got caught up in the hype.
Yeah.
Ignoring traditional valuation metrics, just focusing on that potential for rapid growth.
So they saw the clay, but it wasn't the right kind of clay
Yeah,
to build a lasting business.
exactly. That's where a good investment philosophy comes in. It helps you ask the right questions, analyze the data critically, and avoid making impulsive decisions based on fear or greed.
So it's about having those guiding principles that help you navigate the market.
Yeah.
But how do we develop that philosophy? Are we born with it, or can we learn it?
You know, I think it's a bit of both. Some people are naturally inclined to think critically and independently. But for most of us, it's a process. Learning, experimenting, refining our approach over time.
And reading memos from brilliant investors like Howard Marks, right?
Exactly.
Speaking of Marks, he dives into market crises using Richard Bookstaber's work. Can you remind us about that framework and how Marx uses it?
Sure. Bookstaber really emphasizes the role of liquidity in driving those market swings, especially during crises.
Okay.
He argues that traditional models focus too much on information and fundamentals as the main drivers of prices, when in reality, it's the need for immediate liquidity that often overshadows everything else.
Right, like we were saying, people become liquidity demanders when they need to sell quickly,
Exactly.
no matter the price.
Yeah.
And that can create a domino effect, leading to those big market drops.
Right, and that's where Marx and Oaktree come in.
Oaktree Capital.
Yeah, they specialize in distressed debt, so they're often the ones providing liquidity when everyone else is running away.
So they're basically taking advantage of those forced sellers, buying assets at a discount because no one else wants them at that moment.
That's a big part of their strategy.
Right.
They have the expertise and the patience to wait for those moments. When fear and panic create opportunity, they're not trying to time the market. They're letting the market come to them.
That's pretty contrarian, isn't it? Most investors are trying to buy low, sell high,
Yeah.
chase the trends.
Right, but Marx is saying the real opportunities are in finding those pockets of distress and being the buyer of last resort.
That's a whole different way of thinking.
It is.
It takes a lot of guts to buy when everyone else is selling.
Yeah, definitely. But that's where the big returns can be. If you can identify those undervalued assets and hold them through the recovery.
Interesting. But this approach, wouldn't it only work in certain markets? What about when things are good and there's not a lot of distress?
That's a fair point. Oaktree's strategy is tied to distressed opportunities.
Right.
So when markets are booming and there are fewer forced sellers, they might be less active.
So it's not something you can just apply in any environment.
Yeah.
You need to understand the dynamics.
Exactly. It's not one size fits all.
Okay.
But it shows how important it is to be adaptable and recognize that different strategies work better in different cycles.
Now, we talked about realistic expectations,
Right.
Marx. You can't just expect those double-digit returns forever.
Right.
But how do we set those realistic expectations when the market is so unpredictable?
He emphasizes historical context. Those high returns from the stock market often include periods of PE ratio expansion, meaning investors are willing to pay more for each dollar of earnings. And when valuations are already high, you can't count on that happening again.
So past performance, not always a reliable predictor.
Exactly. It's all about context. You have to understand the factors that drove those past returns and consider if they'll continue. For example, Interest rates are higher today than they were a few years ago. So investors might be less willing to pay those high prices for growth stocks.
So instead of just looking at historical averages, we need to dig deeper. Understand those underlying conditions that are shaping the market.
It requires a willingness to challenge our assumptions, be open to new information, and adjust our expectations.
Makes sense. Marx also talks about diversification and how it doesn't always work during a crisis.
Right, he says. Diversification doesn't always protect us because in times of stress, investors tend to behave the same way, regardless of what they own.
So it's like everyone's running for the same lifeboat, even though they started on different parts of the ship.
Exactly.
So how do we diversify effectively, knowing that it might not always work?
Well, it's about diversifying thoughtfully, not just mechanically. So instead of just spreading your bets across asset classes, think about diversifying across strategies, time horizons, even the psychological profile.
Psychological profile.
Yeah, think about it. Some investors are more risk-averse. Others are comfortable with volatility if you're heavily invested. In strategies for risk-averse investors, your portfolio might not hold up during a downturn, even if it's diversified across asset classes.
It's not enough to just diversify across stocks and bonds. We need to think about risk profiles, too, and how those investments might react.
It requires a deeper understanding of what you're investing in and the motivations of other investors.
This is really thought-provoking. It's clear that Marx isn't giving us a set of rules to follow. He's challenging us to think critically, understand the market, and develop our own philosophy based on sound principles. You know, one thing that really stuck with me from Marx's memo was this idea of disrespecting money. Like, when markets are doing well, people get a little too comfy with risk.
Right. It's like they forget
that
markets can go down too. We see it all the time. Investors chasing the latest trends, throwing money at companies, unproven business models, ignoring basic valuation principles.
And it's not just individual investors either.
No, not at all.
Right. We see with institutions too. Pension funds, endowments, even sovereign wealth funds.
Yeah. Everyone gets caught up in the frenzy.
So how do we guard against this disrespect for money? How do we stay disciplined when it feels like everyone else is throwing caution to the wind?
I think it goes back to what we were saying about having a strong investment philosophy and sticking to it.
Right.
Understanding your risk tolerance, your goals, and the principles that guide you.
It's about having the courage to be different, to say no when everyone else is saying yes.
Exactly. And it's not easy. It takes discipline, patience, and being okay with maybe missing out on some short-term gains.
Right.
But in the long run, that's how you protect your capital and reach your goals.
Now, Marx also talks about the cyclical nature of markets. He says periods of high returns are often followed by periods of lower returns or even losses. So how do we apply that to our own investing?
Well, I think it's about setting realistic expectations. Don't assume the market will always go up or that you can always get double-digit returns.
Right.
Understand there will be ups and downs. And the key is navigating those cycles with a long-term perspective.
So instead of trying to time the market or chase the hot stocks, we should be building a portfolio that can handle the rough patches.
Exactly. And that means having a mix of investments that perform differently in different environments, having some cash to take advantage of opportunities and having the patience to stick to your plan, even when things get tough.
So it's not just about picking the right investments. It's about having the right mindset.
It's about the approach. Investing is as much about psychology as it is about finance.
That's a good point.
Understanding how markets work, how investors behave, and managing your own emotions. That's crucial.
Well, I think we've covered a lot today. We've gone through Marx's insights on market psychology, liquidity, the importance of knowledge, and the dangers of disrespecting money. What are some key takeaways you hope our listeners will remember?
I think the biggest one is investing is a journey, not a destination. It's about constantly learning, adapting, refining your approach. It's about being humble enough to know you don't have all the answers and being open to new information, different perspectives.
And having the courage to think for yourself.
Exactly.
Make your own decisions. Don't just follow the crowd.
Do your own research. Stay disciplined even when it's tempting to do otherwise. And remember, Investing is a marathon, not a sprint.
Great advice. Thanks for joining us on this deep dive into Howard Marks's memo, Investment Miscellany. We hope you found it valuable.
It was a pleasure being here.
Thanks for listening, everyone.